Bloomberg.
This is the countdown to the open. I'm Matt Miller, moments away from the start of trading on what is a shortened trading day for the U.S. equities market. We hit all-time highs again yesterday on the indexes. Right now, futures are a little bit soft, but a lot of people, I'm sure, have already retreated to the beach. Take a look at the New York Stock Exchange opening bell. You got the United States Coast Guard ringing the bell there, and then you've got firefighters ringing the bell on the NASDAQ at the NASDAQ market site. Let's take a look at some of the other assets that we're watching. We're going to talk in just a moment to a cross-asset strategist, so it's appropriate to look at the euro, stuck in a range, and it has been for a while regardless of the snap elections. We'll see if that changes on the weekend. The French, remember, will be voting in their second round. The euro dollar at 107.84. The 10-year yield at 4.40 right now. Down by a few basis points, as maybe investors think they should lock in these rates ahead of, I guess, way ahead of September rate cuts at the earliest. And then you see NYMEX crude at 82.95, holding steady right around the level we saw it yesterday. One of the stocks that we're watching closely at the open, that we have been watching closely for some time, is Paramount. It's higher now on reports that Skydance has reached a preliminary agreement to buy Sherry Redstone's National Amusements and merge it with Paramount. Bloomberg's Abigail Doolittle joins us now for more. Abby?
So the stock is higher. It's up 11%. That's just the best day in about 2 months, though, Matt, because I think that there's still a show-me sense here. So, yes, the news is that David Ellison's Skydance has reached a deal to buy National Amusements, which owns 77% of the voting shares of Paramount, $1.75 billion. Under the old deal, the expectation was that Paramount would essentially merge there. But one reason, at least our legal team here at Bloomberg is saying that the old merger did not happen is because Sherry Redstone is potentially at risk of being sued. Essentially, that if she were to get a bigger payday than everyone else, that she could possibly be sued by those shareholders and enter into litigation. So the question is, has anything changed now that would prevent that? Our legal team, their analysis at this time suggests not. But it's also interesting, Matt, because on the tape, we do have some headlines here. CNBC saying that the deal is expected to be completed by the weekend. And we also have CDS, an insurance on Paramount, coming in suggesting that investors think the deal is going to get done. But there is a little bit of an overhang. And as we speak, the stock is still higher, but at this point, well off the highs, up 8.6%.
Got it. Abigail Doolittle, thanks very much for that. Now, Tesla extending gains this morning after beating delivery estimates. Bloomberg's Simone Foxman joins us now with more.
Yeah, Matt, and shares set up for a 7th straight day of gains. We're looking at the highest numbers in the highest price level since January and the best week since April if we finish out the week like we have seen. Multiple analysts raising their price targets on this name, both bulls and bears. From the bull side, we had Wedbush's Dan Ives writing that, quote, "The demand story has made a significant turn for the positive on the back of these numbers." He's raised his price target to $300 per share, quite a premium to where we're trading right now. So is Bank of America. Deliveries notably better than expected. That price target $260, up from $220. Even on the sell side, folks like Guggenheim, where there is a sell rating, say that those delivery numbers were a materially positive surprise. They're maintaining their sell rating, but raising the price target to $134 a share. And most of those analysts bringing up the importance of that all-important robo-taxi event. We're going to get Tesla's details on this on August 8th, and that trading could be quite choppy until then, Matt.
All right, very interesting stuff. I think Abigail actually yesterday took a look at the technicals and said this was going to happen. So she should be taking a victory lap.
That is the 7th straight day of gains here.
Yeah. She said the stock looked set for gains from the technical perspective. All right, Simone, thanks very much for that. Constellation Brands higher after releasing its latest results this morning. Bloomberg's Jess Menton joins us now for more. Jess?
Well, Matt, looking into also the inflation story here because people were worried when it came to its profit outlook as well as sales that wouldn't keep up. But even though the results were a little bit mixed here, you still saw strong demand when it came into imported beer, particularly when it comes to Modelo, and that's really being driven by some of its younger customers that are pulling that out. If you look at its stock, though, it's kind of bouncing around, up still about 1%, coming off a little bit of session highs here. But if you look at the food and beverage industry group here in the S&P 500, still about flat. And if you look year to date, that group is also flat. But Bill Maloney, one of our squawk here at Bloomberg, is looking at the technical, since you just brought that up, Matt Miller. And specifically, he's looking at the uptrend that this stock's been in since March of 2023, and he's seeing double top resistance around 274 right now. If you look at this stock right now for Constellation Brands, it's actually trading around 261 here. The A&R function, though, if you want to look at where sell side is currently sitting, 23 buys on this stock, 4 holds, 0 sells. You have Citigroup here with a buy, also JP Morgan overweight here. But then you can't forget also when it comes to Constellation Brands here, and especially because if you're looking at particular beers, overtaking some of the sales growth that you would have seen in Bud Light last year. So you still are seeing that demand, even though you are seeing some of its other segments pull back a little bit here. You're still seeing consumers buying Modelo, Matt.
Are you a Bud Light drinker, or I mean, you're Texan, right?
I'm Texan,
so you must
so
drink
I actually
beer.
tend to do more of the Corona and the Modelo, to be honest.
That's what I was wondering about.
I do like it. South
Jess
Texas.
Menton, you know what? I think Katie Greifeld is going to talk to a maker of alcohol-free beer.
Oh, okay, there we go.
In the next hour. So if you're ready to party on 4th of July, or not party, but still want to drink beer, definitely stay tuned for that. Jess, thanks very much. Joining us now is Jim Caron, Cross Asset Solutions CIO at Morgan Stanley Investment Management. Jim, great to get you on the program. After we hit all-time, record highs again yesterday, is this going to continue into the second half? I mean, should we all have FOMO if we're not already in the market and just be pouring in?
Well, I think we are at a point where I think the upside is somewhat limited. It doesn't mean that we couldn't go up another 3% or so, or maybe 4%. It's just that I think a lot of the good news, or a lot of the surprises that that I guess that the market wasn't really expecting has really already occurred. And one of them, namely, is a significant increase in earnings, right? So at the start of this year, many people thought that earnings were going to be very weak, they were going to falter, and it turns out that we're on pace for like 11, 12% earnings growth this year, and that's propelled the equity markets a lot higher. So where do we go from here? The issue that I have with this is that already, if we even start to look into 2025, what consensus expectations are for earnings would be around $277, $278, which would be about another 13% earnings growth from projected levels. If you assign a multiple of somewhere around 19.7 or 20, which is around the consensus, that only gets you to about a 54.75 S&P 500. And as you were saying on the show, we're already through that. So how much further can we go? How much further can this overshoot take us? What we would need to see is a broadening of the rally, a cyclical recovery in some of the more lagging sectors to really start to participate.
Yeah, I mean, first off, I want to give a shout out to Jess Menton and Bloomberg News' equities team, because they've been writing about this earnings expansion. 3 quarters in a row, I think, of expansion after 3 quarters of contraction. But, Jim, is that the S&P 500? Are all those companies growing earnings, or is it really the Magnificent Seven growing earnings and the rest of them still in recession?
Yeah, that's it exactly. I mean, if you look at the top 10 companies in the S&P 500, they account for probably about 38% of the overall earnings growth this year. I mean, disproportionate. If you look at the S&P 490, so X out those, say, top 10 companies, earnings growth is flat to slightly positive, right? So it's really just a very narrow sliver of the overall market that is actually driving these, that's driving these valuations. So even if we look at the correlations within the S&P 500 are very, very low, which means that when we think about the stock market, when we say the stock market, we're really talking about 7 or 10 stocks. We're not really talking about all 500 in the index. So this becomes somewhat concerning, because when we make an economic projection and we say, what is the health of the economy, the equity markets should reflect that in some ways, but we're actually not seeing that. So we need to be a little bit careful in terms of how we connect those two things.
I wonder, nobody ever wants to talk about the election because you don't want to get political, but last Thursday's debate showed us a really disappointing performance from President Biden, and that raises the chances that Trump will occupy the White House. If he does, Larry Summers has said his policies would be extraordinarily inflationary. And indeed, Goldman Sachs has just come out saying that if Trump wins and put those policies in place, that the Fed's going to have to raise rates 5 times. To me, that's a pretty shocking message from Jan Hatzius's team at Goldman Sachs. Do you have to start talking to your clients about the risk around the November election?
So I think what's interesting about this is that when you ask people the question, will the election be a volatility event for the markets, they say yes. When you ask them, what are you actually doing about it? They say not very much, because it's really hard to discern. If we take Trump's supposed policies at face value, which is tariffs and maybe potentially weakening the dollar and spending and all these various things at the headline level, that could be thought of as inflationary. But look, he's already been president. We know what he's done. A lot of times he comes out and he'll throw a very high headline number out there for tariffs, and he's willing to negotiate it back down. So to the extent that the market tries to anticipate what's the real number, what really actually happened versus what is he projecting and what is he saying, there's a huge gap in between those two things. So it's easy to make a projection and say, if I take this at face value, this could mean, the following inflationary outcomes, and this could be bad for the markets. But if we say, what is real? What are you really betting on, and what are you really pricing in? That's what I look to the markets. The market's a better voting machine than what many of the analysts are effectively saying. And what the market's saying is that it doesn't necessarily believe that. Look, if Trump is ahead in the polls as he is today, supposedly, as far as we know, the markets are already pricing this in. I don't think the markets see this. So I think there's a big difference between what the markets are voting on and maybe what Mr. Summers, who I, by the way, admire greatly, is actually saying.
Yep, it's a great point. There's a very big difference between what most politicians say on the campaign trail and then do once they get into office. Jim, thanks so much for joining us. I hope we can have you back soon. Jim Caron there of Morgan Stanley Investment Management. Coming up, one of F1's most wanted gets locked into a new multi-year deal. We'll speak to Pierre Gasly about Alpine F1, his new contract, and future prospects. This is Bloomberg. As F1 drivers scramble to secure seats for next season, Pierre Gasly has locked up his spot at Alpine F1 in a multi-year deal. Now the question is, who will join his team after Esteban Ocon leaves in 2025, and which power plant will Gasly get when the rules change in 2026? Here with me now is GP winner Pierre Gasly, Alpine F1 driver. Pierre, great to have you on the program. Thanks so much for joining us. I want to first ask about the improvements you've made. Alpine had a very tough start to the season, but you and Ocon have been adding to the points in the last few races. What have you done that's different?
Well, thanks for having me, first of all. Yeah, it hasn't been the easiest start of the season. Lined up in Bahrain for the first race of the year on the last row, which was a big disappointment. But then after that, yeah, we just had to focus on the package we had, constant work, and the team has done an incredible work. We've been scoring points in the last 4 races. So yeah, we're having a good momentum, and hopefully we can keep that going in the coming races.
You've signed what's called a multi-year contract. You are basically a team leader for Alpine now. Can you give us any details? Because I seem to recall that you signed a multi-year contract last year as well. Is it, a year plus, or is it a multiple year contract?
Multiple from today onwards. Obviously, it's a constant conversation. Lewis Hamilton this year kind of shocked a bit the market with his move to Ferrari early in January, and it kind of triggered the whole market to start conversations a lot earlier than we all had anticipated. So looking at the future, there is a massive regulation change in Formula One in 2026, and it was important for me to secure a strong position, a strong car, a team that will allow me to perform at the front, and a project I really believe in. It hasn't been the best start of the year, but the team really managed to show me a lot of positive signs. Work at the factory, managed to get some new signings from top teams, Red Bull and Ferrari and Mercedes, and I think we have a strong package. So I really believe in the project. It's obviously very strong connection as a French to be representing the only French manufacturer in Formula One, and yeah, I'm very excited for the coming seasons with the team.
How would you feel about a Spanish teammate? As I said, you've become a real leader in the sport and in the business as well. How would you feel about Carlos Sainz as a teammate?
I would love it. I'm not gonna lie. I want the fastest guy available on the market, and yeah, and it's no surprise that Carlos Sainz is the most competitive guy available out there. I think we got a strong team, a strong package. We've seen that we're able to develop. There's obviously still a long way to go, because we all want to be fighting at the front for podium and win in Formula One. But I definitely believe we got the team and the technical staff to do so. And yeah, let's see what will happen. But yeah, I would definitely not mind.
You've also got Flavio Briatore, who is, clearly a powerhouse in the sport, a champion in his own right, a multi-year champion. What have you seen him do at Alpine?
I saw Flavio, for the first time in Barcelona. In the team. I obviously met him earlier, a couple of years ago, but yeah, properly in his Alpine role. He is extremely motivated, and I definitely welcome anyone that wants to contribute positively to the team. And he's got huge experience, a lot of connections in the F1 world, and definitely want to see Alpine right at the top. So we're sharing the same ambition, the same targets, and yeah, I'm looking forward to work with him.
You think he's talking with Andretti? I mean, FIA has said if Andretti wants a spot on the grid, they should think about buying Alpine. He's obviously a great negotiator as well, and as Americans, we care about Andretti. What's your take on that?
This won't happen. Alpine's not for sale, and Renault CEO Luca De Meo has said it. number of times already. So I think Andretti's got a plan to come in F1, and will be definitely great to see them getting a spot on the grid. But yeah, definitely the Alpine is not for sale, and the ambition is definitely to make it to the top of Formula One.
Do you have a preferred engine supplier if Renault doesn't make the power plant for the new rule change in 2026? It's been talked about a lot that you could become a customer. Would you like to buy a Mercedes motor, for example?
Well, my preferred option is the fastest engine available. I want the strongest package possible to win races, and obviously the car is one element, the engine is another very important element. So just we'll always support the strongest package available.
All right, Pierre, great to get some time with you. Thanks so much for joining us. I know you're going to talk with Bloomberg's Jason Kelly about the business of sports and about the entrepreneurship that you've been doing. So we look forward to hearing more from you. Pierre Gasly there of Alpine F1 GP winner, and now signed on for multiple years to the team. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg. Time now for the trading diary, what you need to be watching this shortened holiday week. A slew of eco data comes out at the top of the hour. At 2 p.m., we're going to get Fed minutes. Mike McKee in Washington for that. Tomorrow, the markets are closed for the July 4th holiday, and the UK holds its general election. If anyone comes back to work on Friday, you have the jobs report to look forward to, and that's a rather important piece of economic data. On Monday, we launch Bloomberg Open Interest, 2 hours of single stock stories and the players who are shaping the trading narrative. My co-anchors, Katie Greifeld and Shanali Bassick, join me now with the preview. Pretty exciting. We've been doing a little rehearsal for this program that we're launching. What's your take? I mean, What are you looking
Very
forward to?
exciting. I mean, we start off the show with Mike Wilson. Strong note on equities. We're going to be coming off a strong weekend of a lot of talking about what's happening in elections, right, between the U.S., France, and the U.K. Katie, what are you looking at?
I'm excited to also talk to Michael Wilson. We're going to be speaking to Howard Marks as well. And playing to Matt's strengths, we have Stefan Winkelmann, of course, the Lambo CEO as well. And just broadly, you think about the concept of this show. Obviously, we talk about the macro all the time on Bloomberg television, but the guiding light here is we're going to tell the macro through the micro. We're going to talk to the CEOs behind these big companies that we talk to all the time.
And maybe when we're done, maybe Matt can teach us how to drive stick shift.
You must know. You just got a new car. Is it not stick shift?
I've tried once. Automatic only.
I get it. Listen, we're going to be talking about the company stories, talking to CEOs, talking to sell-side analysts, talking to fund managers all the time. And one of those analysts, market strategists that we will talk about is leaving JP Morgan.
Yeah, certainly it's a really big moment, right? Because Marko Kolanovic has been such a big voice in markets. He has been more bearish than others. He's had a lower price target than many on the street, most on the street, I believe all of them, at 4,200. Of course, now the chief equity strategist is stepping into his role here of chief market strategist.
Even though equity calls were the problem, right?
Yeah, you have to wonder how they might approach this differently with new leadership. Remember, Marco was also the co-head of research as well, and it looks like there will only be a sole head of research, maybe some positioning open for some new talent at the top.
This is Bloomberg.
All right, we are 30 minutes into the U.S. trading day on this Wednesday, July 3rd. Here are the top stories we're following. Skydance closes in on Paramount. Skydance Media has reportedly reached a preliminary agreement to buy National Amusements and merge with Paramount. That's after talks between the two collapsed last month. Checking in on the hotel biz with Larry Kukulik. He is the CEO of BWH Hotels, which owns hotel brands such as Best Western. We'll discuss the state of summer travel as well as BWH's expansion plans. And a new show. We're launching Open Interest on Monday, which will be live every day from 9 a.m. to 11 a.m. Eastern. My co-anchors Matt Miller and Shanali Basak join me in just a bit with a sneak peek. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at trading at the moment. It certainly looks like the day before a holiday. The S&P 500 not doing much, maybe a little bit higher if you're an optimist. You take a look at big tech, the NASDAQ 100, pretty much unchanged on the day. Meanwhile, you take a look at the bond market. You are seeing a rally there. Of course, 10-year yields currently down about 7 basis points. We are below 440 because even though we do have a holiday this week, we do have a lot of economic data, including some crossing the terminal right now. Let's break it down with Bloomberg's Mike McKee.
Big miss, Katie, for ISM Services. ISM Services plunged most in 4 years, 48.8 down from 53.8. Business activity and production absolutely falls off a cliff. 49.6 contraction. Last month it was 61.2. Now that was a big jump up from the 50s before in April, but it is quite the plunge this month, and you have to ask, what happened? New orders, 47.3 from 54.1. Employment, 46.1 from 47.1. Inventories, only 42.9 from 52.1. And prices paid does fall 56.3 from 58.1, but it is not a significant drop compared with what else we have seen here. So a real fall off, especially in those indexes, the sub-indexes, the new orders, employment, and particularly business activity prices received as well. Everything slows down, and along with the narrative that we have had from jobless claims and from ADP, basically kind of what we're looking for here is more of a chance of a September rate cut, and that's exactly what we've got. We've now gone to a 73% chance of a September rate cut in the OIS trading right after this was released. We'd already headed that direction after jobless claims this morning, but now, Katie, we're really looking at the odds of a September rate cut improving, and we'll see with Fed minutes this afternoon whether that continues.
Yeah, and of course, we do have that Friday's jobs report. I know that you'll be there to break down the numbers and give us some thoughts on whether those also align with that September rate cut. It seems like the bond market is betting on. Our thanks, of course, to Bloomberg's Michael McKee joining us from Washington. Now, reports say that film and TV producer Skydance has released a preliminary agreement to buy Sherry Redstone's National Amusements and agree to a merger with Paramount. Paramount stock, as you can see, soaring right now. So let's get right to Geetha Ranganathan from Bloomberg Intelligence. Feel like we've been here before, Geetha. What about this could be different, this deal, this potential deal that could push it over the line?
Yeah, thank you so much, Katie. So this is, of course, deja vu all over again. And we've been seeing so many twists and turns in this saga over the past 6 months. As you know, just 3 weeks ago, the talks completely broke down. It looks like this time around, what's different is you have a dollar amount that is slightly higher than when the talks broke down. So it looks like Skydance Media is going to pay about $1.75 billion. There is a 45-day go shop period, but I think the real, what could be the deal maker or breaker is that we no longer require a shareholder approval vote. So what Sherry Redstone had wanted in prior negotiations was she wanted a majority of a minority approval for the Class A shareholders. That was a non-starter for Skydance Media, but it looks like that has been nixed. And it also looks like there is much stronger indemnification language this time around in the terms, which basically protects Sherry Redstone from a lot of pending lawsuits that could come if this deal goes through. Because remember, this does favor her over all of the other shareholders.
And I mean, obviously, you see the stock rising right now. It seems like Wall Street seems to think this is a good idea, or at least this is a viable deal. I want to hear your opinion, though. Do you think that Skydance is the proper partner for Paramount?
Yeah, I think what we've realized over the past 6 months, Katie, is that M&A is inevitable. I mean, we know that linear media is in secular decline. We know that some deal has to happen. And, as this sale process has kind of played out very publicly over the past 6 months, we've kind of seen actually a destruction of value. We've seen the CEO being fired. We've seen so many deal-related expenses. We've seen kind of employee morale being completely destroyed. And so some deal needs to happen. I think why Shari Redstone might prefer Skydance to other suitors is because Skydance pretty much will keep the company intact versus selling off parts of the company. And I think that is really important to her and, for her father's and her family's legacy. So I think that's why she might prefer it compared to other bidders like a Sony or, an Apollo, Sony and Apollo combination.
Well, we'll see, of course, if this one actually can get over the finish line. This has been quite a drawn-out M&A process. Let's just leave it at that. Geetha Ranganathan of Bloomberg Intelligence, thank you so much. And let's take this conversation to the broader markets right now. We're going to do that with Barbara Ann Bernard. She is founder, CEO, and CIO over at Windcrest Capital. And, of course, you were one of the ones out early on the inflation being transitory, that being maybe not the best call in your opinion. What's your current view on inflation and this disinflationary trend that we have been seeing?
Well, I think growth is slowing, and you just had the PMI disappoint, and the PMI becomes the CPI. And so I think that's proof that we're having slower growth, and as a result, prices are starting to decline. But ultimately, inflation is sticky, and it really impacts mindsets. And I think we're seeing that not only in markets, but also in the polls.
Also in the polls as well. And I mean, when you think about where we sit right now, growth is slowing. It seems like the whole market is coalescing around a September rate cut. Where do you stand on that? And how much does it truly matter when you think about the trajectory of equities right now, weighed against all the other factors out there?
Well, with equities at an all-time high, right? What are we saying? We're saying growth is slowing, rates will come down and they'll go higher. I just don't like to take these bets. I like investing in things that are much surer, such as infrastructure. But what I want to get to with inflation right now is how the ramifications impact psychology. And what we have this week, which is going to move markets, is elections. And I think that's more important for the second half of this year than rate cuts. So during the pandemic, I think the leaders of developed countries looked like heroes when they printed their way out of an economic crisis. And the backlash of that was inflation and resentment today at the ballot box. So I think that's much more interesting to focus on right now.
And let's talk a little bit more about that the election is more important than rate cuts, because I talk to a lot of people who tell me the exact opposite. So walk me through that call a little bit more.
Well, elections in democratic countries are not about the 1%, they're about the majority. So what the majority isn't telling you in the UK, in the US, and in France right now is that they're not happy, right? Anything would be better. And so they're voting far left, far right, and these are extremes. And extreme moves have implications. So markets discount future cash flows, and I mean future after-tax cash flows. So if you look at the run-up in the US market right now, I think part of that is the higher likelihood of a Trump win and what that would mean for right-wing corporate tax policies, i.e. higher corporate margins. And you're seeing that in France, and I think the UK will have the opposite impact. So elections and policy matter, and you've seen it not only in developed countries, but in less developed countries such as Mexico and Panama this year. And so, yesterday, the newly appointed president of Panama gave a speech where he suggested there might be an environmental audit, which gave hope of the Cobra Panama mine being restarted. And the reason that was material is that Cobra mine is 5% of Panama's GDP, employs 8,000 people, and supplies 1.5% of the world's copper inventory. So I think being focused on policy and politics is certainly important and does move markets.
And so let's draw that out a little bit, because so far, and it's early, and of course, a lot can change between now and November, and of course, the eventual presidency that we do get. But so far, I've heard that if we had Trump retake office, that would be bad for bonds and it'd be good for stocks. That, of course, is an oversimplification. But what are some of the themes that you're thinking through when you do consider the policy angle?
I think it's different this time, right? We have more debt than we had when Trump was in power last, and we're later along in the cycle. And really, I don't have any control over that. What I have control over is the types of investments I can make. And I think the biggest risk to markets right now is the debasement of monetary debasement and inflation. So I want to buy assets that cannot be printed, such as commodities and infrastructure. So that's where I've focused my returns, because in a world where I see higher volatility and fund flows being concentrated in a passive manner, increasingly in expensive tech stocks, I just prefer the predictability of the cash flows that I see in infrastructure.
Well, I wanted to ask about equity. So if you're focused on those more real assets, commodities, and the like, I mean, does that leave you underweight on things such as equities, such as fixed income?
It does. So much so that I much prefer being a price maker in the private markets than a price taker in the public equity markets right now. So what we actually did was we took a portion of our fund's assets and took a private stake in a private infrastructure developer where we could structure and finance projects where we had visibility on the cash flows, and found that was a much safer bet. And so we really like infrastructure because we think governments are broke, and that's providing an opportunity for private capital to fill these the demands of these essential services of society. And what you get with infrastructure is you get long-term PPAs, power purchasing agreements, right, where you can build in inflation, you can structure it so that it's linked to inflation. You can set the offtake agreements in the currency of your choice. And due to the permitting process, these projects are characterized by large barriers to entry, monopoly-like characteristics, strong cash flows, double-digit operating margins. This is just a much safer way to invest right now when I'm looking at markets in all-time highs and I have to think, oh my goodness, how do they push materially higher versus, what could possibly go wrong? And I think a lot could go wrong. The other thing that I don't like about the private markets right now, or the public markets, is that all of these assets are being invested in a passive way. And that creates a very difficult setting for an active equity manager. So what you want to do is not be in an orphaned asset. So if you look at infrastructure, you have all of these mega funds who are competing with each other to raise record amounts of AUM. They all need good investments, and they're all too big to write the first check for very good projects. So I can write that first check knowing that I have, a ton of buyers lined up who can't, and that's a nice arbitrage. The other thing is, I do think the trajectory of rates is lower, and projects have very high capital requirements post the permitting process. And I think a falling rate environment is going to be a tailwind for those projects as they get financed.
Right.
So that's my case for dodging the public equity markets right now in favor of private markets where you have predictability and the ability to structure investments in a way that limits your downside.
Barbara Ann, I feel like we're just getting started, but unfortunately we have to leave it there. Have to have you back soon to talk more about the election and political risk and, of course, those private markets. Our big thanks to Barbara Ann Bernard of Windcrest Capital. Now, coming up, Athletic Brewing is brewing the top-selling non-alcoholic beer in the U.S., and we'll be speaking to Bill Shufelt. He is the company's co-founder and CEO. Next, this is Bloomberg. Well, Athletic Brewing is tapping into a brand new market. It's the craft brewing company, now the top non-alcoholic brewing company in the U.S. And that rapid rise not slowing so far this year, with sales rising 60% year to date. Joining us now again, I am pleased to say we have Bill Shufelt. He is Athletic Brewing co-founder and CEO. Bill, great to have you back on the show. And tomorrow's July 4th. I am psyched about it. And it feels like an American tradition to have hot dogs and burgers and also drink beer. So I'm wondering how you're trying to seize on that moment and have people take a look at non-alcoholic beer as well.
Absolutely. Thanks for having me back, and cheers to July 4th week. It is such an exciting time of year. 9 of the 10 biggest beer weeks are through the summer. 4th of July week is over 40% bigger than the average beer week nationally. And that does mean it's bigger for non-alcoholic beer too. Non-alcoholic beer tends to pace exactly with alcoholic beer. I'd love to issue a challenge to any of your listeners this week, to any cooler they're making, any party they're hosting, to have 1/3 non-alcoholic drinks. If you have a third of your beer athletic beers, I would challenge anyone that those will be the first to be out of stock. The reason I'm confident in that would be that over 70% of people drink beer during 4th of July week, but 60% of Americans barely consume any alcohol at all. So they will be really excited to see these offerings at a daytime occasion.
All right, so the challenge is out there. Make a third of your cooler non-alcoholic beer, specifically Athletic Brewing, and it'll be out first. Hopefully we have some people writing in after the fact. But I want to talk a little bit about how you keep the growth going, because, of course, you are enjoying the top spot right now. But when you can think about how to continue the momentum, how important is it to actually get in physical shops? How important is it to get in bars, for example, on the menu so that people actually try it?
All of the above. I think it all goes to authenticity and investment. Athletic authentically got this category going. We're a co-founder-led company. The need for our products arose right out of my own lifestyle, just like a very normal, healthy, modern adult lifestyle. And then we have invested by probably a factor of 10 more than anyone else into this category's infrastructure in the U.S. And so we built 2 enormous breweries. Just a couple of weeks ago, we announced another huge brewery acquisition where we'll be investing heavily into the California area again. And that's to make really high quality, totally differentiated non-alcoholic beer. But the investments aren't just in our facilities and our quality. It's in our sales team on the street. It's in our marketing. We just launched our biggest marketing campaign ever called Ask for Athletic, which really brings awareness to the category. It was playing nationally through the NHL and NBA playoffs, and will go through the summer. But it's about that investment, and really awareness for the non-alcoholic category, and especially athletic beers, is still so low. We're really excited about the future.
Well, let's talk about that investment as it compares, of course, to the competitive landscape, because this is something we talked about the last time you were out on. Now you have some of these traditional beer makers coming out with their own versions of non-alcoholic beer. Heineken 0.0, for example, has climbed in popularity. How do you continue to compete when you think about some of the heft and the infrastructure that some of those brands have?
It's great. I'm a total positive sum thinker. Non-alcoholic beer is about 1.5% of all beer right now. It's probably tracking towards 3% by the end of 2024. And in our head, we think it's going well into the double digits. So we're thinking very positive sum. If you go back 10 years when I was working in finance, there wasn't a single name brand flagship beer in the non-alcoholic beer category. And it was that pain point which led me to start Athletic Brewing. And now we're so psyched to have the company of, Heineken, Guinness, Corona, a number of great craft beers in the category now too. So Athletic is the #1 non-alcoholic beer producer nationally. We're about 20 share of the category. The next biggest is 15. And Athletic is bigger than, outside of the top 5, Athletic is bigger than the next 100 brands combined. There are 37 new non-alcoholic brands in the category alone this year. So it's a really nice breadth of offerings. But even with all those major multinationals in our category, the investment I spoke to earlier, Athletic's driving over 33% of category growth year to date still, even with well over 125 brands in the category.
And Bill, before I let you go, I do want to talk about expansion as it relates to new offerings. Of course, you've come out with new brews when it comes to beer. Are you considering cocktails, for example? I know there's been a lot of growth in that category as well.
So we see a really long, multi-decade trend in non-alcoholic beer. We think health and wellness, better for you, moderation are trends that toothpaste isn't going back in the tube. And in 25 years, we think it's going to be much bigger than present. So we're really focused on that opportunity, but really excited for the whole category. If you look at the broader adult beverage category, it's probably going to be double digits % of every subcategory in there. Wine, spirits, cocktails. And so as a consumer, I am very excited for the development of the whole category and know well over 100 brands doing thoughtful things in the space.
All right, Bill, it's great to see you again. Have a great July 4th. Hope to speak to you again soon. That is Bill Schufeld of Athletic Brewing. Now, coming up, we're launching open interest on Monday. My co-anchors Matt Miller and Shanali Basak join me next for a sneak peek. This is Bloomberg.
Bloomberg.
All right, starting Monday, we're launching Bloomberg Open Interest. It's going to deliver the market-moving news you need to know to get a jump start on the U.S. trading day. And my co-anchors, Matt Miller and Shanali Basak, they are sitting right next to me, joining me now for a preview. And before we get to the lineup, let's talk about the vision here. This is something that we've been working on and crafting for a while, and it's really about bringing the macro to the micro, Matt.
Yeah, absolutely. I mean, I want to talk to CEOs. I want to find out how they run their businesses. I want to find out how they view the economy, because it's so important, obviously, to the broader market. But we can't just get data from, the ISM. We can't just get data from the Bureau of Labor and Statistics. We need to get our own, to make our own beige book, if you will, and that's, I think, what we're going to do for 2 hours every day.
How it actually is filtering into the C-suite and, of course, into the consumers that actually buy products. And we have some great people to kick us off on launch week.
Yeah, we sure do. We have a 9 a.m. sharp. We have Mike Wilson to get us started. Of course, it's an equity-focused show. We are going to start with a top equities guest, and we also have Howard Marks here to provide some perspective. Guys, we have a lot of news next week, given that we're in the middle of election season here.
Oh my
UK,
goodness.
France, the United States as well. And so a lot of the guests that we have next week will give us a ton of perspective on how to think about that volatility into the rest of the year.
Yeah, obviously political risk will be front and center. So too will, of course, the Fed. We do have Jerome Powell in D.C. see. And you know that Matt Miller's involved because we're also talking to the Lambo CEO, day one.
Yeah, the CEO of Lamborghini. Look, we've been talking so much about the consumer, right? And we always do. The consumer makes up the lion's share of the economy. And we know that right now it could be the consumer in the lower couple quintiles could be struggling, but the wealthier consumer could also be struggling. And that's the kind of thing we're needing to talk about with Lamborghini's CEO, with Ducati's CEO, with Porsche's CEO. So hopefully we can get them all on the program.
All right, a lot to look forward to. Our thanks, of course, to Shonali Bassick and Matt Miller. And don't forget, Bloomberg Open Interest. It will premiere this Monday at 9 a.m. Eastern. This is Bloomberg. Well, AAA says that 71 million Americans will be traveling for this 4th of July holiday weekend. And here for a look at summer travel and a broader look at the industry, I'm pleased to say we're joined now by Larry Kukulik. He is BWH Hotels President and CEO. And of course, BWH is the owner behind hotel brands such as Best Western, SureStay, and World Hotels. So Larry, let's start broad here and talk about the state of summer travel, because clearly Americans want to travel. It seems like we've moved past that narrative of revenge travel. When you look out over the course of the next few months, what do you see?
Well, thank you, and happy 4th of July. Consistent with AAA's prediction of 71 million travelers traveling just over the 4th of July week, we are seeing that type of strong demand by guests who want to travel. Interestingly, that 71 million in context, that's 5.7 million over 2019 numbers. I don't call it revenge travel. I call it travel that people understand the importance of experiences and traveling. And that, I think, is a lasting effect of what we experienced.
And compare and contrast for us, clearly travel demand is very robust. It seems like we've shaken off the pandemic and then some, but how do occupancy levels at some of your hotels compare to what we saw in 2019?
Well, thank you. Compared to 2019, we are far above those numbers in terms of revenue per available room. We're a tremendously strong leisure brand, and as a result, when we hit a season like summer, we see ourselves indexing several points above the industry across those relevant segments. So compared to, I'll call it history, rate is very, very strong, and occupancy continues to grow.
So occupancy continues to grow, but you talk about the revenue per room. I mean, is that just your pricing going up rather than the volume of people booking growing?
Well, I would say occupancy, again, continues to grow, but that the rates that we're being able to charge, and those are based upon the cost of operations and inflation and the effect it has on hotel operations, rates will continue to grow. But of course, everything has a ceiling, and we understand that probably better than most brands because we pride ourselves on being a value brand to travelers who are traveling for experiences, family, retirees who are out there traveling. You know, we have 4,200 plus hotels around the world, and wherever someone wants to travel, we have a hotel for that experience.
Yeah, it's a good point, too, that you have a unique view of that value-conscious traveler. And like you said, of course, there's a ceiling here for when it comes to rates and how high you can raise them. I mean, how close are you to that ceiling? We talk all the time about the trade down that's happening across the industries, how tired the consumer is. How much further do you think you could actually raise prices here?
We're not experiencing trade down. We're experiencing people who are willing to pay for a quality stay, for the value that they pay. And please keep in mind, while we historically have been viewed as, I'll call it a value brand, we now have 18 brands across every segment, from luxury down to what we call premium economy. We don't see people trading down. We see people wanting to have the experience that they believe they're entitled to. And so we're very proud of the fact that we have a hotel for any type of occasion and for any type of developer as well, because we want to make sure when we develop new hotels, they're going to be successful in the market they're placed.
And of course, we're talking about travelers, we're talking about summer travel, which means vacation in a lot of cases. But where are we on business travel, for example? Are you seeing that come back?
We absolutely are. We're seeing a 5-point lift year over year in business travel. And we're also seeing, by something that we consider very important, our loyalty program growing year over year, and our .com, bestwestern.com and worldhotels.com. Bestwestern.com is growing at an extensive rate of 6% year over year, which is tremendously important because that's the loyalty guest who knows they're going to get the best available rate and be recognized as a loyalty member. The short answer to the question is yes, business travel is coming back. So is leisure.
And let's talk a little bit about expansion. Of course, you're pushing out internationally as well. You recently highlighted your growth ambitions when it comes to the Middle East. And I'm curious, when you're evaluating new markets to expand into, I mean, how much does geopolitics weigh on your mind and the risks associated there?
Of course, that's one of the many factors. You look at GDP growth, you look at the politics of the location. You look at the amount of business travelers that want to go there because they may be a great exporter of goods into the United States. There are multiple factors we look at. You have to look at the eagerness of developers and the availability of funds to develop new hotels. You mentioned the Middle East slightly. We recently concluded our presence at the Arabian travel market, where we executed agreements with 8 new hotels and a branded residence, which is very different for us. but for 1,889 rooms. We see the Middle East, Saudi Arabia in particular, with regard to those contracts, as a tremendous growth market. I'd also like to speak quickly about Europe. You know, Europe is absolutely having a phenomenal summer season right now. They're up year over year, across the year, 15%. Pent-up travel, well, there may be more pent-up international travel, but you have things like Euro Cup. Now you have Wimbledon. You're going to have the Olympics. Plus you have historic locations throughout Europe, Venice, Rome, Athens, Berlin, and we have hotels in all those locations. So for us to be up 15% in that continent is phenomenal.
All right. Strong growth in Europe this summer. Larry, we have to leave it there. Really appreciate your time today. Our thanks, of course, to Larry Kukulik of BWH Hotels. Now coming up, when will deal-making return? Ethan Klingsberg of Freshfield takes us through the factors driving M&A this year. This is Bloomberg. Well, it's time now for our daily Wall Street Week conversation. We're taking a look at changes in corporate strategy. Companies once steadfastly opposed to going public are now embracing the opportunity. And joining us now with more is Ethan Klingsberg. He is Freshfield's head of U.S. corporate and M&A, along with Wall Street Week's David Wested, to uncover the compelling forces driving companies into the public spotlight. And it feels like when it comes to M&A and when it comes to IPOs, we haven't really seen some of the levels that we were getting used to in like 2021.
Yeah, absolutely right. I mean, it's gone down and it hasn't come back as fast as people have thought for all sorts of different reasons. Ethan knows the reasons. So let's start with this going private thing. At one point, it was all the rage and drove a lot of your business. Is it as active today as it has been in the past?
Well, first of all, there is a decent amount of M&A activity. I think you guys just reported that my team, we did about $104 billion of M&A leading for clients just this first half of the year. So I think we're in kind of a normalized M&A market, but why aren't we seeing more taking privates of public companies by private equity? You know, there was an expression that I used to hear in the boardroom a lot, which was, you know, we can't do this as a public company, we need to be private. And what that meant was we can't do all the cost cuts. We can't do the big investments in R&D, CapEx, and marketing while we're public, because that meant we're really having everything geared toward the next quarter. And these kind of restructurings, big activities would mess up toward the next quarter. And then starting about 12, 15 years ago, a lot of activists started saying, I'm investing in public companies. I want you to act like as if you're a private equity portfolio company. Ed Garden from Trian was very big on this, and it was very appealing. And now more and more companies, rather than just managing toward the next quarter, I have lots of clients who are putting out targets for margins and revenues, key metrics for 3 years from now. And they're saying, look, don't get distracted by the next quarter. So then the private equity comes in and they say, you know what? There's not a lot of secret sauce we can add because these companies are acting as if they're private equity portfolio companies now. So they're fully priced and the market's appreciating that. So we don't see as many take privates in that sense because of that. There's still some boards and managements that don't have the wherewithal to go in this direction. And then there's some where investors don't have confidence, and then we have some where private equity are big investors and it's time to flip. But there's a lot of companies now that are fully priced because of that strategy.
And so, I mean, I think about where we are when it comes to the public markets. We're at record highs across all indexes. And what I keep hearing is that it's not a bubble because you aren't seeing the big levels of M&A. You aren't seeing the IPOs that you were seeing really at the peak of the markets in 2021. And I hear what you're saying, that there's a lot of private companies out there that don't necessarily feel that pressure to go public because they want to do private company things. But what do you think sort of changes the dynamic where we do see more activity come to the public markets?
Well, remember, we had a huge acceleration of private companies going public during the COVID era, right? A lot of those companies haven't panned out. So